Hi, everybody. Lance Browning, Income Solutions Wealth Management, here in Tyler at Central Command on Troop Highway. Happy New Year. Hope you're doing well. I know, I recognize, I get it that we're all generally very, very passionate about things like religion, politics, college football. I understand that. But I just want to wade in a little bit into those semi-troubled waters here. And what we want to do here, and the purpose for this video blog, is going to be we want to try to separate the narrative from the data, from the actual data, the actual facts. We want to differentiate between what the running narrative is. Okay, so bear with us and we'll get started. So all in all, it was a pretty good year for the market in 2023. This was very welcome after the abysmal year we had in 2022. So for 2023, the S&P 500 was up about plus or minus 24%. The Dow Jones Industrial Average was up about 14% plus or minus. The Barclays Aggregate Bond Index was up about 5% plus or minus. And that's after the worst year in history in 2022. Your typical balanced portfolio of stocks and bonds would have been up somewhere around 12% or so. So while on the surface that may sound really good, I think it's helpful to put these returns, particularly those of the S&P 500, into better perspective. Vote early, vote often. This is one of my favorite political quotes of all time. It can be attributed back to the old Chicago days of Al Capone and even Mayor Richard Daley, but I love that quote. In 2023, we added a new term to our investment vocabulary called the quote-unquote Magnificent Seven. So the majority of the gain in the market in 2023 came from essentially 7 stocks, with the largest concentration in the index, just speaking the S&P 500, in terms of market capitalization. So these 7 stocks, we'll name them Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Facebook, accounted for the entire gain of the S&P 500 stocks in 2023. This chart is from December 2023, our good friend Lance Roberts down in Houston. Basically 1 week before the end of the year, before the end of 2023, the S&P 500 was up 17.28% for the year. Of that 17.28%, the Magnificent Seven stocks contributed 19.35%. You see here with the red arrow at the bottom right, or 112% of the gains for the entire year. As you can see, not all stocks were created equal last year. 7 did really, really well. The other 493 stocks in the S&P 500, not so much. Here, and we get people to ask, okay, so Lance, what's your best idea? What's the best advice you can give me? Well, the best advice I can give you as an investor would be to get elected to Congress and do insider trading on the information you have, okay? So here we can graphically see the investment returns of various members of Congress last year. Looking for the way to beat the market? Again, get elected to Congress. It seems to be a very profitable endeavor. And you got to love those public servants, but you can see a list of specific congressional and senator representatives and by party. So it's not all blue, it's not all red, it's everybody. Just find that very, very interesting. Which political party? So I get that question a lot, and again, the narrative is, okay, so if my guy gets in and the other guy's out, things are going to be great, or things aren't going to be good again until that guy's out and my guy's in, or if my guy stays in and the other guy doesn't get in, things are going to continue to be really good. So Which political party does the market prefer? What does the data tell us? Here's what we call a mountain chart showing average annual returns for various presidential administrations by party. Again, blue being Democrats, red being Republicans. We will dive into these numbers more deeply here in just a second. I really like this slide that LPL Research did. What we see here are 4-year presidential cycles. It's also broken down by re-elected president, new president, and an average. Clearly, that third year is by far the best, and that would have coincided with the year 2023, which is the third year of Joe Biden's first presidential term. You can see in the box over in the far right that the market does considerably better with regime changes when you have a change in the White House. With the 2024 election looking very much like it's going to be a rematch of the 2020 election, what would we consider a quote-unquote new president? And I realize this is a very busy slide, so I just want to highlight a few things on it, okay? So on the far left, you can see the stock market's performance by each term year from beginning with Andrew Jackson all the way down to Joe Biden. At the bottom of that same chart, you'll see the number of up years in green versus the number of down years in yellow. Drilling a little deeper into these numbers, let's look at the chart on the top right. Here, you see the win percentage, quote unquote win percentage of each year of a 4-year presidential term. In other words, what percentage of the time was the market up during those years? In the middle right, you see the number of up years here in the green was 129. The number of down years here in red was 62. So up years in these presidential cycles led down years by almost 2-1. Lastly, at the bottom right, you can see the average return per presidential years 1 through 4. As we will discuss throughout this whole discussion, you see year 3, like we saw in the previous slide, is historically the best. Drilling a little deeper on the 4-year presidential cycle, we can see again that year 3, obviously, again, is by far the best, being up 88.9% of the time. On the box in the far right, we see year 4 broken down by president up for re-election versus a president that is a lame duck. Very interesting, since 1950, year 4 president up for re-election has been up 100% of the time. Very, very interesting. Here's the politics of investing, kind of how we break that down. And again, does it matter who's in Congress? Does it matter who's in the Senate, the House, the White House? Let's talk about that. Let's go back post-war. So let's look at 1946 to 2020. We'll start over here in the far left. So a Democrat president, on average, the market's been up 9% a year during Democratic presidential terms. The market's been up about 7.4% during Republican administrations. When you had a Democratic Senate, the market was up about 6.3%. When you had a Republican Senate, the market was up about 11.3%. Average of all these here you see in the dotted line is about 8.3%. So keep going to the right as we move left to right. A Democratic House, the market was up 7% a year on average. A Republican House, the market was up 10.7% on average. Total Democrat control, House, Senate, White House, the market was up about 6.7%. Total Republican control, House, Senate, White House, 8%. When you had a split Congress, Here's chalk one up for gridlock. The market was up 12.9%. The whole point of this exercise is that there's not a lot of difference in market returns based solely on political parties. I know that's not the narrative, but I want to show you the numbers. As we've consistently said over the last couple of years, it's all about the Fed. We'll talk more as the year goes on along about what we can expect from the Fed. Our best educated guess is that the Fed will be under tremendous political pressure to have everything humming along just in time for the November elections. Stay tuned. So, in case we needed an added element of challenge, we also have the potential for a government shutdown. There's very bitter debate going on right now on Capitol Hill regarding what needs to be paid for and when. The political ruling class in both parties has failed to pass a budget in over a decade, and they've operated on what are called, quote unquote, continuing resolutions. I'll give you the Lancepedia definition of a continuous resolution, okay? Continuing resolution is kicking the can down the road. Basically, we're going to continue to ignore the problems and are going to raise the credit limit on the government's credit card until it maxes out again. What could possibly go wrong? Well, we're about to find out. We've got another continuing resolution potential shutdown this month in February of 2024. And if the political ruling class swoops in at the 11th hour to save us from all these problems that they created, we get to do this whole exercise again throughout the course of this year. You can't make this stuff up, folks. We just want to say thank you for taking the time and tuning in. We will be in touch the rest of the year, so stay tuned for more of these blogs. God bless. Have a great rest of your year. Bye-bye.